Okay, so Assalamu alaikum everyone, and thank you for taking out time from the middle of your day to join us to learn a little bit more about Sharia Portfolio Canada, our strategy, our kind of the main gist of this is Warren Buffett's guide to investing. So how to actually do it the Warren Buffett way, but with Sharia compliance. So we look forward to having this discussion with you. There is a box for questions. If you guys do have any questions, feel free to ask them. If I can during the presentation, I will answer them. Otherwise, at the end of the presentation, there will be an opportunity for me to answer those questions as well. So let's get right into it. We'll just go through a little bit about what Sharia Portfolio Canada is, our main value proposition, and then we'll go through what is mainly the crux of this presentation, which is the 10 principles of investing. And one of the big crux of that is why it's important to stay the course, how our models reflect on our strategy, as well as how it kind of goes hand in hand with the Warren Buffett way of investing, and tying that in with Sharia compliance. After which, we'll also discuss a little bit more about financial planning, and then we'll leave the floor open for questions. I know that it is in the middle of a workday for many, so we'll try to keep this as quick as possible to ensure you can all get back to whatever it is you were doing. Once again, we do appreciate you joining us during the day for this webinar. This is just a quick disclaimer, just general information saying that the information that is provided here in today's presentation is mainly just for information purposes and is not to be construed as any investment advice specifically. So at Sharia Portfolio Canada, our main objective as a wealth management firm is to help you reach your financial goals. And one of the ways that we do this is through investment management, where your portfolio is actively and professionally managed by our portfolio management and investment committee team. And we make sure that this is done in a way where it is aligned with your goals as well as your ethical values. Just to give you a little bit more information about Sharia Portfolio Canada. So we are Canada's only licensed portfolio management firm dedicated specifically to Sharia compliance and investing in an ethical way. We are registered in Ontario, BC, Alberta, and Quebec. We were founded in 2003 in the US. So we have a US-based arm and a Canadian-based arm now. This company was actually founded as Sharia Portfolio in the US in 2003 and has grown really fast since. In the US, they are licensed by the SEC. In Canada, we are licensed with the OSC, which is the Ontario Securities Commission. Our partnered custodian is Fidelity Clearing Canada. And what this means is that being a client of Sharia Portfolio actually gives you access to the same protection that you would get in any other major financial institution in Canada. For example, insurance under CIPF, which is a Canadian Investors Protection Fund, as an example. Fidelity Clearing Canada is our custodian, means that your accounts and your assets actually sit under custodianship of Fidelity. Now, what is Sharia Portfolio actually about? So what we offer our clients are tailored specific solutions customized to your own values, concerns, your goals, your financial plan. Because every client, every person is in a different stage of life with different goals and different concerns that affect them. And what we do is we work with you on a one-on-one basis to ensure that we come up with a very personalized plan and an investment strategy for you. The benefit of working with us is that we are actually a corporate firm that specializes in this industry, and we currently manage over 1.4 billion in assets globally. This is as of October 2024. Now, it's important to note that the main reason for financial planning, investment management, is for you to make sure that you are on track for your goals, your retirement, whatever it is that you want to achieve in life. And we help you to ensure that you're able to achieve those goals. Now, the 10 principles of successful investing. This is the main gist of the presentation. And I really want you to focus on these 10 parts. The first 3 points are something that we'll dive a little bit deeper into in the next couple of slides. But just to kind of go through these very quickly. Number 1 is to stay calm and continue investing. Always stay calm. There is always volatility in the markets. And when that volatility exceeds your ability to kind of tolerate it, there's different things that you can do. But one of the most important things to do is to remain calm and continue investing. It's always important to avoid trying to time the market. You may have heard of the saying that time in the market is more important than timing the market. So it's important to maintain that sense of perspective when you are investing, especially when it's for the long run. And when volatility is out of your reach, it's important to be able to reassess the level of volatility that is in your portfolio. It may mean that you need to maybe tone it down from moving from a little bit aggressive to maybe something more moderate. So it's important to constantly reassess that with your advisor and see what's best for you. Another important thing, which is one of the main principles of investing, is to remain diversified. Diversified does not mean be invested in 100, 200 stocks. No, it just means don't over concentrate into one specific security, asset class, or aspect of investing. It's important to remain diversified across different aspects of investing. And constantly look for opportunities, because opportunities are always there, right? And us as a portfolio management team, we also maintain that perspective where we're constantly on the lookout for opportunities that could benefit our clients. Number 7, make sure that you're regularly rebalancing your portfolio. For example, if you have a 60-40 portfolio, which is 60% equities and 40% in fixed income, over time, that 40% or that 60% in equities may actually shift when the market has done really well for, let's say, the past 5 years in general. Let's assume it's done really well for the past 5 years and you started with a 60-40 portfolio where you were 60% equities. That 60% in equities may now actually be 75%. So it's important that in order to be able to maintain your level of risk tolerance in alignment with your portfolio, it's important to make sure you're rebalancing, which means bringing that 75% equity position back down to 60%. Sharia Portfolio Canada, what we do is we actually rebalance our clients' portfolios on a monthly basis to ensure that they're always in line with their recommended model portfolio and that they're in line with their financial plan in order to meet their goals. Again, it's very important to stay focused on the long term, putting time on your side. Starting early is always beneficial. But for those who haven't started, you still are able to put time on your side because the best time to have started investing was yesterday. And then, of course, it's very important, especially if you're working with an advisor, to make sure that you're reviewing your portfolio, your financial plan, your status on a frequent basis. Now, this may be semi-annually for some, it may be annually for some, but it is important to make sure that you are reviewing your portfolio on a frequent basis. Now, going back to the first 3 points here about avoiding to time the market, maintaining that sense of perspective, staying calm, staying the course, and investing on. Let's go through why. I did a webinar earlier this year where I actually spoke about this as well. And many were very appreciative of this information because it helped put things into perspective for them. And it was only fair to have this included in today's presentation because it just matches what we are talking about. What you're seeing here is the fact that if you miss just 10 of the best days in the market over any long-term period across different markets, you would have drastically reduced returns. So let's look at the graph on the top left for a second. This is based on the annualized returns of the S&P 500, which is the US index, for 10 years ending 2023. During that 10-year period, if you just stayed invested if you just stayed invested without going in and out of the market or going to try and time the market, you would have had an annualized rate of return of 12%. Now, take that 10-year period, assuming 365 days a year, that's 3,650 days over a 10-year period. From all of those days, if you missed just 10 of the best days in the market, your return is more than half compared to the person who stayed fully invested for those 10 years. If you missed 30 out of 3,650 days, and sorry, that's actually not 3,650 days, but it's because the trading days are usually 5 days in a week. But in the 10 years, if you only miss 30, you would be negative. And it's even worse if you miss 50. That is the S&P 500. If you look at the bottom right of the graph, bottom right of the slide, the graph there, this has the same information, except it's ending 2019, 10 years, so 2009 to 2019. But it's a different market. It's the S&P TSX, which is the Canadian market. And you can see that it's almost the same results. If you stayed invested for the entire period of 10 years, you'd be at close to 7% annualized return. Whereas if you missed just 10 days, it's close to half of that. So it's two different markets, slightly different time periods, but very similar results. And this shows that it's very conclusive that staying invested, no matter what, for the long run, is what's beneficial for you and your portfolio. If you look at the graph in the bottom left, again, that's the S&P TSX Composite, which is the Canadian market. This actually goes from 1980 all the way to December of 2023. If you stayed fully invested and you started with $100, you'd be at $4,042. That's the yellow line. Now, if you missed 10 of the best days, again, this is the same concept, just a much longer time period. Now we're looking at 1980 all the way to 2023. So that is 43 years. The first two that we talked about were 10 years. This is 43 years now. And it's the same thing. It's the exact same thing. You missed 10 of the best days, and instead of $4,000, you're sitting at under $2,000, just over half. Just over half of your return has now been cut down by just missing 10 of the best days in a 43-year period. And if you miss 25, it's even worse. I think you get the point. It's important to remain invested. Now, we're talking about missing 10 of the best days. How do you know when these best days come? We don't. We don't know when the best day will come in the market. So take a look at this. The good days actually happen in bad markets. So if you look at the best days in the market, right? The pie chart on the right, 50% of the best days actually come during a bear market. And 28% of them come during the first 2 months of a bull market. And the market does not tell you before it does what it's going to do. And if you're not invested, you're going to miss those best days, because it is very, very hard to time the market. Now, let's put this a little bit more into perspective for you. So let's do a quick case study. Okay, so you have 5 different people. We're going to look at a 20-year time period from 2003 to 2022, end to end, January to December end. Each of these individuals are given $2,000 every year. And different scenarios show how they use the $2,000 differently and where they end up. So you have one, which is known as the perfect timer. Now, every year, they take that $2,000 and are able to invest that $2,000 at the best point of the market, so at the lowest point of the market every year, which is very tough to do, almost impossible to do that. If they do that, at the end of the 20 years, they end up with $144,937. So about $145,000. Then you have what is known as the quick investor every time they receive it. So they receive it at the beginning of the year. Every time they receive the $2,000, they invest it right away. Every time they receive it, same time every year, they just put it in. They end up with around $127,000. Not too different. The monthly investor who takes that $2,000 and actually splits it up into 12 months and averages out into the market, known as dollar cost averaging, they end up with almost the same amount as the one who invests immediately at the beginning of the year as soon as they get the full $2,000 instead of splitting it up over 12 months. Then you have the worst timer. They invest the $2,000 every year at the peak of the market. They end up with $110,000. Not a very big difference between all of these. The worst of all of this is, of course, the one who stays in cash. They got to $2,000 every year, they maintain a cash position, and they invested in, let's say, a fixed income asset class. So this kind of puts into perspective how, of course, being a perfect timer is impossible. So let's look at the other three, which are actually possible to do, which is invest it immediately, dollar cost average, or just have really bad timing. I mean, it's also very hard to be very bad at timing consistently, but if you look at the chart here, they're all pretty much even over a long period of time. Now, what's our approach to actually helping you invest? And I hope that that puts things into perspective with regards to investing, how to remain invested, especially when you go through volatility in the markets, especially on days like yesterday, today, before beginning of August, right? It's important to maintain perspective and to just continue, stay calm and continue investing. Now, when it comes to our strategy, there's two things that we're very keen on, and one is diversification, but not over diversification, but diversification to make sure that you're invested across different asset classes, different types of securities, as well as different sectors, different companies within sectors. And we do this through what is also known as value investing. So we like to look for opportunities that have value in them. And for those of you who are aware of Warren Buffett's work, that was his core strategy. It's looking for value in companies that he's looking to buy. Now we'll dive a little bit further into to discuss that. Before that, I just want to share a little bit more about the models that we have. We have the completely conservative model, which is known as the Sukuk model. Sukuk is our alternative, it's our fixed income asset class that's generally an alternative to bonds. So you have a model ranging from Sukuk all the way to aggressive, with moderate and income being kind of in the middle. On the chart up here, you'll see that there's some target returns. Now, depending on the model you're in, these are the long-term annualized returns that we target, that we aim to achieve for these models. Now, I want to emphasize the point that this is a long-term annualized target rate of return that we aim to achieve for each of these models. And the model you're in will be based solely on your specific situation. Like I mentioned before, we customize and tailor solutions specifically to you and your situation. But this is just to give you an idea of what sort of returns we are looking to achieve based on the model that you're in. So the aggressive portfolio, generally the target rate of return is about 12%, whereas the growth is about 9%. On the moderate side, you're looking at about 7%, on the income about 4 to 5 to 6, and on the conservative a little lower than that. Conservative and Sukuk are pretty much in line with each other because of the similar allocation to the Sukuk fund. Now, the Buffett way of investing. Just want to share a couple of things that he has actually mentioned that are very, very important when looking at investing. And it also ties in with what we spoke about before with regards to staying invested. So Buffett says to stop trying to predict the direction of the market or the economy, interest rates, or elections in general. Always have that long-term view, right? Be fearful when others are greedy as well. Be greedy when others are fearful. Many of you have heard that. Now, I love this line because it says, as far as you're concerned, the stock market does not exist. Ignore it. And I really like that line because when you're investing in the stock market, you're buying companies. When you're buying a company, it ties in with what he says at the end. An investor should ordinarily hold a small piece of an outstanding business with the same tenacity that an owner would exhibit if he owned all of that business. Buy a business, don't rent stocks. So when you're investing in the stock market, we have to change our perspective on the fact that we're buying something that changes in price every day and trades and goes up and goes down. We're buying businesses. And when you're buying a business, you're buying it because it's a valuable business that provides a stream of solid cash flow over a long period of time that you project into the future. And that cash flow has a value. And when you're getting a good deal on that value, you're buying that business. So we need to kind of step back and think about it in a way where we're not actually buying something that's trading on the market. We're buying a company, we're buying a piece of a company. And we just need to make sure that the company we're actually buying is quality and has the potential to flourish in the future, right? Always invest for that long term. I mean, if real estate today had a price tag on top of it, it would be a completely different market. Your emotions would be very different. The way you would approach real estate would be very different in every house today. Every property had a price tag up there, which changes every second. So when you're investing in stocks or when you're buying companies, you need to kind of have a little bit more perspective with regards to what it is that you're actually buying. What are you actually investing in? Right? The stock market is manic depressive. It changes moods every day. Sometimes it's bullish, sometimes it's bearish. And we need to kind of step back from that and look at it from a more holistic view. Warren Buffett generally has, I mean, this is very, very simplified compared to what it actually takes and what he actually has on his checklist. But in general, there's a couple of things that Warren Buffett looks at when he wants to invest in a company, right? And some of these are actually in line with our view on the markets as well and how we look for opportunities. One of them is business quality. So does this company actually have good long-term prospects? How is their revenue actually generated? How are they earning their income? Do they have a consistent operating history? Is the business understandable? Is it sustainable? Is there opportunity within the market? So one is understanding the business on its own. Second is looking at management. Who is actually running the company? Are they capable of doing that? Are they transparent? Are we able to actually see what's going on behind the scenes in that company? Because if something's not very transparent, then you don't really know what you're investing in, right? And that's where due diligence comes in. Before any decision is made by the investment committee and our portfolio managers, due diligence is 100%. Due diligence is a process that definitely needs to take place, and it does so to maintain being knowledgeable and also having a thesis behind the decisions that are being made. So every decision that is made on our client's portfolio has a thesis behind it, has a reason. And transparency is something that's very important because if a company is not transparent, we're not able to make that calculated and valid decision for that company. The next thing is financials, which is, of course, security analysis, looking at the balance sheet, income statement, cash flow statements, reading between the lines, right? Seeing the quality of the company, looking at management, looking at the type of business it is, it all has to tie into what is the company actually doing and what are the numbers? What's the bottom line here? And then finding value. So what's the value of this company with regards to its discounted earnings compared to current market value? So if based on the future cash flow of the company is actually worth $150, but it's trading today for $100, right? Just a general example. There's value in there because it's actually worth 150 but trading at 100. Sometimes a company may be worth 100 but trading at 150. So it's overvalued, right? So it's important to look at the company, the type of company it is, the quality of business, management, the financials, and then actually seeing, is there value in investing in this company? So you look at that, Okay, how do you actually find value in a company? And once you have a company, okay, is it Sharia compliant? And that's the twist here, right? We do that. We look for value in the markets, but at the same time, we ensure that any opportunities that we take chance on or anything that we do on our client's portfolio is Sharia compliant. And we do this based on the AOFI standards. So AOFI sets out guidelines to determine whether something is compliant or non-compliant. Now, one of the main things we look at when it comes to Sharia compliance is, okay, what are the non-compliant income sources, and we want to avoid these. So in general, it's industries like gambling, alcohol, pork, weapons, military, highly leveraged businesses, tobacco, adult entertainment, music, cinema, broadcasting, and other several industries. What we also look at is consideration of the geopolitical landscape and things that are happening around the world, and specific companies that we may not want to invest in because of the type of business that they have. So we're very careful about how we pick and choose which companies we want to invest in and have as part of our clients' portfolios. And then we go to the ratios, which are actually set by AOFI as well. How do we determine? And these are three very simple, just high-level bullet points with regards to the ratios, just to kind of give you an understanding of how we actually look at whether a company is Sharia compliant indeed. But one of them is the interest-bearing debt over a 12-month average market cap should be less than 30%. So if a company is worth 1 billion, the debt that they have on their balance sheets over a 12-month trailing average should not be more than 30%, which means no more than 300 million. If it is more than 300 million, it's deemed non-compliant as per Sharia compliance guidelines set by AOFI. Secondly, cash, cash equivalents, and receivables should also be less than 30%. So if you've got cash of more than 300 million, it's deemed non-compliant as per AOFI guidelines, because a lot of the times cash and cash equivalents that are sitting with the company on their balance sheets are earning a lot of interest on them. And the last point is that cumulative revenue from non-compliant activities and non-operating interest income should not exceed 5% of total income. Meaning, in general terms, no more than 5% of their income should be actually coming from non-compliant sources. If it's less than 5%, it's still deemed compliant in the sense where you can invest in that company, but we also work with our clients to ensure that we can help you purify your portfolio at the end of every year to ensure that if there is that non-compliant source of income less than 5% that's impacted in your portfolio, we can purify your portfolio to make sure that you've cleaned it out of that. So in general, this gives you a view of how we actually ensure Sharia compliance is intact and part of your portfolio. Now, we've talked about the principles of investing, how the Warren Buffett way ties into investing with Sharia compliance. We've talked about our models, the target returns that we have. That's all investment management. When it comes to wealth management, and we're a full service wealth management provider, when it comes to wealth management, investment management is one part, one pillar of wealth management. A very, very important pillar of wealth management is financial planning. Now, investment management ties into financial planning, but financial planning is the most important thing for you and your financial journey. What we do is we actually sit with you, your advisor would sit with you and make sure that they're understanding your full situation, your goals, your aspirations, and you will have a comprehensive financial plan, which you keep with you, and it's your go-to. And it's something that's reviewed on an annual basis. Every time something major changes in your life, you go back to that financial plan. And I'll give you one quick example of why a financial plan is important. Let's say you have an asset base. You have some goals and you have a wish to retire in 10 years. 10 years. Can you actually retire in 10 years? You need a financial plan to tell you that. If inflation is 3%, how does that impact how does that impact your retirement? Will you be able to retire in 10 years if inflation is 3%? Perhaps not. At 2%, maybe. What if it's 3.5%? What do you need to change today to be able to make sure you reach that? So the first thing is, what's your goal? Now, how do we actually reach that goal? And during that time, while you're working towards reaching a goal, things change, life happens. And whenever major things change in your life, it's important to have that reflected on your financial plan. And that's what you're working with your advisor. You're working with your advisor to ensure that your financial plan is intact, you're on track to achieving your goals, and if anything is changing in your life, it's reflected correctly. The returns that you have, are they enough? Are you going to need more? Do you need to be in a more aggressive portfolio? Are you too aggressive and you actually need to be a little bit more conservative because you don't need to take that much more risk? These are all things that are answered in your financial plan. And it's very, very important in order to be able to build wealth, plan for retirement, and preserve your assets for future generations. So as a client of Sharia Portfolio Canada, you would have a fully tailored and customized solution for you to be able to achieve these goals in your life. So why is this important? Like, why is the financial plan so important? Let's continue. When you retire, you need to be able to generate that retirement income. How will you be able to do that? Where is your income going to be coming from? All of this needs to be planned in a way that gives you peace of mind so that you can sleep at night. When you have a financial plan, you know whether you're on track or whether you're not on track. And if you're not on track, you know what you need to change to be able to get on track. And it's important to be able to plan for the future, not just with regards to retirement, but estate planning, tax planning. How do you actually pass on your assets and your wealth to the next generation with minimal liability? God forbid you pass away tomorrow. How much of a check to the CRA is your spouse or your family going to have to write? How do you mitigate that risk? How do you make sure that we can actually minimize that tax liability for you when you do pass away? How do we transfer your wealth to the next generation, right? Intergenerational wealth transfer is a huge, huge and important aspect of financial planning. So it's important to take all of these things into consideration and have that financial plan in place. Well, with that, I know a lot of you probably have to go get back to work. I hope this has been genuinely informational and helpful for all of those who did attend. The floor is now open for questions. There is a box on your screen where you can type in any questions that you have, and I'd be more than happy to answer them for you. Sure, there's questions. I'm sure I didn't explain everything that you wanted to hear. Now, my contact information is up on the screen. I'm more than happy to also have a discussion with you offline. So please do note my contact information down. Feel free to reach out directly to me on my cell or my email address. More than happy to set up a meeting with you, chat, discuss how we may be able to help you with your situation, your goals. And yeah, okay, I see we do have one question here. It says, can we say that ESG is halal? In general, ESG is not necessarily Sharia compliant because they may have companies in there which are socially and environmentally friendly, but not compliant as per Sharia compliance requirements, especially as per AOP guidelines. So ESG is basically the closest thing to halal from the secular market, but it's not necessarily halal just because it is ESG. Because you may have companies that are socially and environmentally friendly that are doing right things, but they may not be compliant. One example is, let's say you have a company that's really good for the environment, environmentally and socially friendly, full green company, let's say, but they have a lot of debt on their balance sheets. right? That technically wouldn't be a company that is compliant as per AOF guidelines. I hope that answers your question. Yeah, once again, I mean, for anyone who may have questions later on, feel free to take down my contact information, and I'd love to get in touch with you after this meeting or at a time of your convenience to discuss further about how we may be able to help you. We'll give it a couple more minutes to see if anyone else has any more questions before we can conclude. Anyone with any more questions? Happy to answer them. I still see a couple of attendees on the call, so if you do have anything, feel free to shoot them out. Any questions with regards to our models, how we manage the process, the investment committee? Can I use my retirement gain abroad? Um, I think that's a very specific question, and it would depend largely on your specific situation. There's a high chance that you may be able to. Um, and sorry, if I understand correctly, you're asking if you have retirement gains outside that you want to use here. But if you also have your RSP here, which you want to use outside, that is most certainly possible as well. Of course, it depends on your situation, your relation to Canada at that point. But that is definitely something that I can help you with if you want to get in touch with me, and we can discuss that in a little bit more detail. But in general, yes, it is possible, but it strongly depends on the specifics of your situation as well. Okay, we'll give it around 1 or 2 minutes to see if anyone else has any more questions, and then we'll conclude. Okay, we'll give it 10 seconds.